Good morning, good afternoon, and good evening. Welcome to the ACAD Reader's Briefing, the podcast that turns a full issue of a major magazine into a focused 30 to 60-minute audio briefing. Today, we are bringing you a reader's guide to the August 10th, 2026 issue of Barron's. This issue's cover is titled The New Wild West. Against a bright red background, Western boots, the Dallas skyline, and the opening bell of the Texas Stock Exchange bring together three versions of Texas: its frontier identity, its new financial ambition, and its rapidly expanding technology economy. The cover asks whether Texas-style hyper-capitalism can remain a model for American growth, or whether low taxes, light regulation, abundant energy, and available land are beginning to collide with water shortages, infrastructure pressure, and weaker corporate guardrails. Texas now hosts 57 Fortune 500 companies, more than any other state, but the same boom is beginning to expose its physical limits. This issue revolves around five major questions. First, can the United States expand exports of advanced AI chips while restricting Chinese AI models without undermining its own strategy? Washington wants American computing infrastructure to dominate global markets, but wider chip access can also strengthen Chinese laboratories, while broad model restrictions could increase costs and concentrate the U.S. AI market. Second, could upcoming cancer and cardiovascular drug trials reshape both medicine and biotechnology investing? Big Pharma faces hundreds of billions of dollars in patent expirations, while pivotal results involving cancer vaccines, bispecific antibodies, lipoprotein, and next-generation blood thinners could determine new standards of care and future acquisition targets. Third, how far can Texas continue growing before water becomes the binding constraint? In Corpus Christi, industry uses about 60% of local water, while AI data centers could sharply increase statewide demand. Under severe drought conditions, Texas could face a roughly 20% water shortfall by 2030. Fourth, will Starlink replace traditional telecom networks or become dependent on them? Satellite systems excel across remote areas, but dense cities still require terrestrial towers, spectrum, and enormous local capacity. The future may therefore be cooperation between satellite and ground networks rather than simple disruption. Fifth, how can leverage turn one investment failure into a broader market event? Record margin debt, speculative call options, leveraged funds, and derivative-based exchange-traded funds can create feedback loops in which forced selling in one market triggers losses and further selling elsewhere. Taken together, this issue is about systems approaching their limits. Technology policy collides with national security. Pharmaceutical innovation collides with patent expiration. Texas growth collides with water. Satellite disruption collides with network physics. And financial leverage collides with liquidity. That brings us back to the cover. The new Wild West is not simply Texas. It is an economy expanding so rapidly that its resources, rules, and safeguards are being tested at the same time. Next, we turn to the individual article briefings in this issue.
Section 1. Medical, Health, and Life Sciences. This section begins with the clinical foundations behind the renewed strength in biotechnology. Cancer vaccines, bispecific antibodies, lipoprotein treatments, and new anticoagulants are approaching major tests. It then turns to the spread of myopia and Cooper's effort to build growth through children's lenses, a business separation, and possible acquisition interest. 1.1. New drugs could fuel fresh highs for biotechs. Whether biopharmaceutical companies become long-term growth assets still depends on whether their medicines pass clinical trials. Cancer and cardiovascular studies will report several pivotal results later this year, and those readings could change patient treatment, company valuations, and industry acquisitions at the same time. Summit Therapeutics' Ivonescimab combines an immune response with the ability to cut off a tumor's blood supply, and the Harmony 3 trial will compare it directly with Keytruda. Merck and Moderna's personalized cancer vaccine cut the risk of melanoma relapse in half in a randomized Phase 2 study, while Phase 3 interim results are still pending. Novartis's Pelacarsen is being tested in a Phase 3 trial of 8,300 people to determine whether lowering lipoprotein reduces heart attacks, strokes, and emergency stent procedures. Bristol-Myers Squibb's Milvexian is trying to prevent clots with less bleeding. Meanwhile, between $200 and $300 billion of branded medicines will lose patent protection by 2030, pushing large drug makers to buy smaller companies with medicines in development or already on the market. 1.2. This visionary stock looks ready to rally. Cooper is the world's second largest contact lens maker with nearly 30% of the global market. Its children's myopia control lens can slow progression between ages 10 and 18, and one-day lenses are safer than lenses requiring daily cleaning. The more immediate change is a possible sale of the surgical business, which accounts for about 1/3 of revenue, with most proceeds going to share buybacks. A sale would leave Cooper as the only large pure-play contact lens manufacturer and could also make it a takeover target. Contact lens growth has slowed, however, and the company cut organic sales guidance from 5% to about 4% in June.
Section 2. Macroeconomics, Public Policy, and Geopolitical Competition. This section examines how policy choices change growth paths. American chip exports and model restrictions pull in opposite directions. Texas is meeting the limits of water and corporate governance. Europe is exporting digital regulation through market size. And Japanese rate normalization is rearranging long-term capital. Chinese savings, American labor growth, employment data, and manufacturing signals complete the macroeconomic picture. 2.1. How America's artificial intelligence strategy plays into China's hands. The goals of expanding technology exports and protecting national security each have a clear logic. Pursued together, however, they create an internal contradiction. The United States is increasing the computing power available to Chinese laboratories while trying to restrict the models those laboratories train, and that inconsistency gives China room to catch the artificial intelligence frontier. In January, the Commerce Department approved sales of NVIDIA H200 chips to China, and by May it had approved 10 buyers. Broad exports to Saudi Arabia, the United Arab Emirates, and other markets also created a route for Chinese laboratories to rent computing power in overseas data centers. The White House understood the loophole but resisted stricter overseas review because it would raise transaction costs and weaken demand. At the same time, a blanket restriction on Chinese open-weight models could raise costs for American companies and concentrate the domestic market further in Anthropic, OpenAI, and Google. A more coherent approach is to build an active American open-weight and open-source ecosystem and give domestic researchers and companies sufficient computing power, data, and model choice. 2.2. The New Wild West. Texas is betting big on business. Will it end badly? Texas is testing a form of hyper-capitalism. Population growth, natural resources, no personal income tax, and light regulation drew corporate headquarters, financial institutions, and artificial intelligence data centers. With 57 Fortune 500 headquarters, the state edged past California, and its economy became the 8th largest in the world. Growth, however, has reached physical limits. Industrial facilities use about 60% of the water in Corpus Christi. One reservoir fell to 8% capacity. Residents cut use by 19%, while large users cut only 3%. and a severe drought could leave a statewide water shortfall of 20% by 2030. The governor has already paused approval of new data centers for a freshwater review. Deregulation also shifted rules toward management, and Texas business courts, shareholder thresholds, and local exchanges raised concerns about shareholder rights and a race to the bottom. The prosperity created by energy, land, low taxes, and light regulation is now meeting counterpressure from water, infrastructure, and corporate governance. 2.3. Europe sets the tone on big tech regulation. Europe is using its market size to set the direction of global digital regulation. The European Union fined Google €890 million under the Digital Markets Act. The European Court of Justice upheld an earlier €4.1 billion judgment. And Apple and Meta platforms also faced rules under the Digital Markets Act and Digital Services Act. American technology companies earn nearly half of their revenue overseas, while Europe is becoming more dependent on Silicon Valley's artificial intelligence tools, creating a high-risk interdependence. The United States Trade Representative threatened a Section 301 investigation and possible tariffs against regulation viewed as discriminatory. Europe's hard line therefore raises compliance costs and could turn a dispute over digital sovereignty into transatlantic trade and investment risk.
2.4. Helicopter money in China. China's investment misallocation is not an isolated problem. It grows out of excessive saving and weak household consumption, which leave large amounts of capital searching for somewhere to go. Property remains depressed. The trade surplus is already near a historical high as a share of the world economy, and additional manufacturing investment would increase excess capacity, deflation, and trade friction. The commentary therefore proposed direct cash transfers to households, designed where possible to encourage births. Such payments could turn savings into consumption and ease the long-term pressure from population decline. The policy would be politically difficult, however. Without a change in household income and consumption, China may continue to face below normal growth and deflation for the foreseeable future. 2.5. To understand the yen's plight, look to the bond markets. The yen may be Japan's currency, but it is also America's problem. The yen fell to a 40-year low as Japan's public debt exceeded 230% of gross domestic product, and decades of suppressed interest rates shifted fiscal pressure into the currency market. Once 30-year Japanese government bond yields approached 4%, the return available to Japanese investors after currency hedging became comparable with long-dated United States Treasury securities. Japanese insurers, therefore, had more reason to buy at home. Long-term borrowers in developed markets are losing an important buyer, and the invisible subsidy Japanese institutions provided to high-deficit countries is ending. The latest coordinated intervention to support the yen was designed to reduce sales of United States Treasury securities, showing how sensitive officials are to the effect on American yields. The reversal of Japanese capital outflows is arriving just as bond markets in the United States, Britain, and Europe all need buyers, forcing a repricing of global long-term financing costs. 2.6. A false productivity boom. The most important economic constraint in the United States may not be a lack of technological progress, but slow labor force growth. Average annual labor force growth fell from 1.7% between 1950 and 2000 to 0.9% after 2000 and 0.35% after 2020. Population aging, retirement, delayed household formation, fewer births, and slower net immigration created a long-term labor shortage. Even if artificial intelligence raises output per worker, total production is still limited by employment and labor force participation. Gross domestic product could continue to rise while employment stagnates. but the gains would be more likely to flow to owners of capital than to create broader jobs and incomes. If higher output does not bring more employment and household income, the more accurate description is a false productivity boom. 2.7. A weak employment report. The report delivered a weak signal without a single clear policy answer. United States non-farm employment fell by 23,000 in July. The previous 2 months were revised down by about 100,000, and the 3-month moving average dropped to roughly 20,000. Unemployment still fell to 4.1%, not because employment improved, but because both employment and labor force participation declined and some people stopped looking for work. Markets initially reduced expectations for a September rate increase. One volatile report with large revisions, however, cannot by itself prove that a recession has begun. 2.8. Manufacturing renaissance. Manufacturing expansion received further confirmation. The United States Institute for Supply Management Manufacturing Index rose to 55.6 in July, stayed above the dividing line of 50 for a 7th consecutive month, and reached its highest level since May 2022. Production rose sharply and employment improved. Slower supplier deliveries could reflect stronger demand, but they could also signal renewed supply chain pressure. The more convincing evidence came from firm orders, rising backlogs, and low customer inventories, all of which support future production schedules. Trade policy uncertainty and high input prices remain restraints, but the data still leave room for expansion to continue.
Section 3. Technology, Communications, and Digital Finance. This section follows the digital reconstruction of communications and financial services. SpaceX wants to extend Starlink from broadband into mobile service, but urban capacity, spectrum, and ground infrastructure point toward cooperation with traditional carriers. At the same time, remittances are moving from cash agents to digital platforms, while technology shares swing between artificial intelligence investment, cycle fears, and earnings narratives. 3.1. SpaceX will not destroy telecom, it will reinvent it. SpaceX is unlikely to destroy the telecom industry in the near term. Future networks are more likely to combine satellite capacity with the ground assets and wireless spectrum accumulated by traditional operators. Starlink already serves 12 million internet users and has margins above 60%, while third-generation satellites could provide 10 times current capacity. A complete constellation could cost more than $100 billion, however. Satellites cannot carry all the bandwidth required in dense cities, and direct-to-device technology remains immature. SpaceX cannot yet operate alone and may need mobile virtual network agreements with existing carriers. That creates a prisoner's dilemma, because the first carrier to cooperate could gain at the expense of the others. If space and ground networks need each other, the value of spectrum and base station connections rises rather than falls. The sell-off reflected fear of the future more than Starlink's actual effect over the next 1 or 2 years. 3.2. This payments market disruptor could rise 35%. Remitly is turning international money transfers into an entry point for a broader financial platform. The global remittance market exceeds $900 billion a year. The company has more than 10 million active customers, and second quarter transfer volume reached $23.5 billion, up 27%. Once customers enter the platform, they can use a wallet, short-term advances, a debit card, and business payments. Management raised 2026 revenue growth guidance to 21 to 22% and also increased its profit forecast. The market will continue to pay a premium only if transaction volume, customer retention, and revenue from new products keep growing. Competition, marketing costs, pricing pressure, and cryptocurrency alternatives could still slow the improvement in profits. 3.3. Technology's volatile week offers new narratives and one bargain stock. For companies caught up in the artificial intelligence trade, merely good results are no longer enough. SanDisk, Western Digital, and Advanced Micro Devices all exceeded profit expectations, yet their shares fell because of cycle concerns and gains made before earnings. Palantir took the opposite path. Revenue exceeded expectations for a 12th consecutive quarter, sales growth accelerated for a 13th quarter to 93%, and the stock rose 29% the next day. Atlassian also gained 35% after strong results. AppLovin's growth slowed, but after the sell-off, its valuation fell below the Standard & Poor's 500 index for the first time in 2 years, leaving the stock looking attractive. 3.4. Snap's two big problems say, stay away from this stock. Snap's first problem is the structure of its user base. Daily active users rose 5% in the second quarter, but North America fell 7% and Europe fell 2%. All growth came from other regions, where revenue per user was about $1, compared with $10.26 in North America. The company is also betting on augmented reality glasses priced at $2,195, while the design, weight, pre-order demand, and expected return remain in doubt. Lawsuits over children's mental health could also materially affect the business and financial results. Buying the stock therefore requires belief that core market users will return and that the expensive glasses will open a new business.
Section 4. Capital market structure, trading mechanisms, and systemic risk. This section follows the mechanisms that amplify market moves. A highly leveraged fund faced margin calls and exposed the feedback between margin debt, call option speculation, and leveraged exchange-traded funds. Profit growth, special purpose acquisition company financing, competition among Texas exchanges, and the Wall Street bonus cycle reveal other forms of market incentive and institutional fragility. 4.1. What a hedge fund's fall says about this market. The collapse of a highly leveraged fund exposed the risk appetite of the stock and options markets. The Situational Awareness Fund, once valued at $45 billion, faced margin calls and had to sell large stock positions at low prices. Margin loans, call option speculation, and cross-market holdings can reinforce one another. Falling prices trigger forced sales. Forced sales push prices lower, and the decline produces new margin calls. Margin debt is already at a record, while leveraged exchange-traded funds filled with derivatives let inexperienced investors control enormous positions with little capital. No one knows exactly how the failure of one highly leveraged fund would be magnified through other connected funds. Margin finance trading in Korean chip shares can also affect the American market, showing that leverage and volatility cross continents. The episode should lead traders, banks, brokers, and regulators to review risk models and margin lending procedures. 4.2. The market is rising again and getting cheaper too. American stocks became cheaper even as they rose. The Standard & Poor's 500 index gained 22% over the past year, while its forward price-to-earnings ratio fell from 22.1 to 20 because profits grew faster than share prices. In the second quarter, 86% of companies beat profit expectations, and index earnings rose 50.4% from a year earlier across several industries. Doubts remain. Accounting for artificial intelligence spending may flatter profits, and the cyclically adjusted price-to-earnings ratio is at a level not seen since the internet bubble. The market returned to an upward path after a 2-month pause, but profit quality and signs of weakness in employment still require attention. 4.3. Special purpose acquisition companies are back. A red-hot stock is a cautionary tale. Dave lost 97% in the year after its merger with a special purpose acquisition company. It later became profitable and gained 65% in 2026, but the recovery did not remove the structural warning. Shareholders redeemed 88% of the merger vehicle, shrinking $254 million of planned capital to less than $10 million after costs. And the company never built a stable institutional base through a traditional roadshow. Among 300 companies that used the same structure in 2021 and 2022, shares fell an average of 64% in the first year and about 70% over 3 years. Dave survived on its fundamentals, but it still faces a Justice Department lawsuit, disputes over customer fees, and a regulatory gap, while the discount left by its financing structure has not fully disappeared.
4.4. A high noon showdown for the stock exchanges. 3 competing stock exchanges have opened in Texas, but the state remains far from becoming the American capital of trading. The Texas platforms of the New York Stock Exchange and NASDAQ mainly support dual listings, while the Texas Stock Exchange still has no listed companies and little trading. Electronic markets separate the place of listing from the place of execution, so a new platform can attract companies without easily overcoming the liquidity advantage of established exchanges. Texas business courts, shareholder rules, and local identity offer branding appeal, but also raise concerns about protection for insiders and restrictions on shareholder proposals. More than 10 new trading and listing platforms appeared over the past 20 years with limited success. 4.5. Banks lead a bonus boom. Wall Street year-end bonus expectations rose sharply after second quarter results. Incentive pools at major investment and commercial banks are expected to increase 5 to 20%, with the strongest gains in equity sales, trading, underwriting, and advisory work. Hedge funds, asset managers, and wealth managers may also pay more. The bonus cycle still shows how violently financial industry income can move. Investment banking pools rose 35 to 50% in 2021 and fell 30 to 40% in 2022. Artificial intelligence is reducing junior hiring, while its effect on senior revenue-producing executives may be much smaller.
Section 5. Consumer Markets, Retail, Real Estate, and Brands. This section places brand strategy beside wealth divergence. Coca-Cola gained an advantage through an asset-light model, product continuity, and an earlier move into zero-sugar drinks. The ultra-luxury housing market boomed on stock and artificial intelligence wealth, while ordinary housing remained weak. Retailers competed through new products, discount channels, physical stores, and artificial intelligence shopping tools. 5.1. Pepsi's challenge. It cannot seem to keep up with Coke. Coca-Cola currently leads Pepsi for reasons that go beyond taste. Coca-Cola sold nearly all of its bottling operations and became an asset-light marketing company. Coke Zero also entered the market 11 years before Pepsi's zero sugar product and kept greater continuity in its product and packaging. More than half of Pepsi's business comes from snacks, while glucagon-like peptide-1 weight loss drugs are reducing the food noise that drives impulse purchases of cookies and chips. Coca-Cola gained 26% for the year, while Pepsi remained slightly down even after dividends. Coca-Cola's valuation still looked high, and Pepsi's beverage business could recover, but its snacks remained a concern. Until a better entry price appears, the best position in big soda may be zero. 5.2. It is the mansion economy. $10 million is barely enough. The mansion economy is booming while the ordinary housing market remains weak. Last year, the 10 largest ultra-luxury markets recorded 1,601 home sales at $10 million or more, worth about $28.6 billion, as stock market wealth and artificial intelligence equity brought more cash buyers into the high end. Total United States home sales fell to 4.7 million, a 14-year low, and the median price remained close to where it was 5 years earlier. High costs for materials, labor, land, and permits make workforce housing difficult to build, while the lock-in effect from earlier low mortgage rates keeps inventory scarce. Mansion sales are also feeding debates over second home and billionaire taxes. The article's final point is that the real shortage may not be mansions, but common sense. 5.3. Brighter days for retail brands and stocks. Consumers have been more resilient than expected. Retailers are opening more stores than they close, and demand for space exceeds supply. New products, World Cup marketing, discount channels, and artificial intelligence shopping assistants are supporting demand. Shoppers still emphasize value, but fresh and innovative brands can sell at full price. Artificial intelligence may help companies curate assortments, analyze data, write product descriptions, and reduce costs. Dana Telsey favored Tapestry, Ralph Lauren, Ross Stores, and TJX companies, while also watching the modernization of Gap and Victoria's Secret. She also warned that elevated inflation, a lower savings rate, weak housing, and higher fuel costs could restrain consumption in the second half.
Section 6. Asset Allocation, Income Strategies, and Retirement. This section examines risk reduction and sources of income before retirement. Rising stocks and higher bond yields created an opportunity to reduce portfolio volatility. Other articles challenged the traditional story of gold as an inflation hedge, recorded support from geopolitical risk and central bank demand, and offered income alternatives through Telecom dividends and international high-dividend funds. 6.1. About to retire. The market is cooperating. For investors approaching retirement, this may be a good moment to reduce portfolio risk moderately. The Standard & Poor's 500 index rose 13% for the year, and the 10-year United States Treasury yield reached 4.6%, combining stock gains with more attractive bond income. A market decline at the start of retirement, followed by continuing withdrawals, can exhaust savings more quickly, so sequence of returns risk matters. A 60% stock and 40% bond portfolio can be a starting point, although the right mix still depends on pension income and tolerance for volatility. The Bloomberg United States Aggregate Bond Index currently yields about 4.9%. Yields would have to rise by more than 0.81 percentage point over the next 12 months before total return turned negative, a larger cushion than in most of the past 20 years. 6.2. If you buy gold to protect against inflation, you are doing it wrong. A recent paper argued that the data do not support gold as an effective inflation hedge. It found a correlation of only 0.07 between gold and inflation, and adding gold to a portfolio of stocks and bonds did not prevent inflation from eroding value. The belief survived partly because of herding, anchoring, and confirmation bias. Investors remembered periods when gold appeared to work and pushed other evidence out of view. A popular story can therefore survive for decades without support from the data, and gold's power to attract belief may itself become a reason people continue to own it.
6.3. Fresh demand for gold. Gold has found new sources of demand. Gold exchange-traded funds recorded their largest inflow since the Iran war, and emerging market central banks continued buying to rebuild reserves and diversify foreign currency assets. The commentary therefore raised gold from neutral to overweight. If real interest rates decline, the opportunity cost of holding an asset with no yield will fall, while geopolitical uncertainty may continue to provide support. This remains an allocation judgment and does not mean gold prices can only rise. 6.4. Where to find safety in telecom dividend stocks. The market may be overestimating how quickly Starlink can replace traditional networks. That fear lowered valuations and raised dividend yields for carriers and tower companies. AT&T's dividend yield approached 5% and Verizon's remained near 6%, while the three carriers retained substantial cash flow coverage for their payouts. Starlink still needs ground stations or carrier partners to expand service, and direct-to-device technology is not mature, so the real threat may not emerge until the next decade. While investors wait for the market to reassess the relationship between satellite and ground networks, they can continue collecting dividend income. 6.5. Top foreign stock funds for income-hungry investors. International stocks have long paid higher dividends than American peers because overseas markets have a smaller technology weight and more mature financial, industrial, and energy companies. Vanguard International High Dividend Yield Index Fund yielded 3.5% over the past 12 months and can diversify portfolios already heavy in American technology. Chasing the highest yield can be dangerous because weak companies often offer high payouts for a reason. Franklin International Low Volatility High Dividend Index Fund screened for sustainable dividends, lower volatility, and currency hedging. Its maximum decline over 5 years was 10%, compared with an average of 23% for peers. Investors comparing funds should focus on free cash flow and the dividend yield over the past 12 months.
Section 7. Corporate Actions, Insider Trading, and Event-Driven Investing. This section focuses on actual trades by corporate insiders and major shareholders. Albertsons executives bought shares after a record low. Jeff Bezos used a preset plan to sell part of his early Amazon position. And Schedule 13D filings recorded recent changes involving Tether Holdings, Pictet Asset Management, BW Group, Oman International, and BBRC International. 7.1. Albertsons executives make stock purchases after shares hit lows. Albertsons reported disappointing results, lowered its full-year outlook, and fell to a record low of $11.03. The chief executive, the executive responsible for mergers and corporate affairs, and the chief financial officer then used their own money to buy a combined 218,909 shares, signaling confidence to the market. It was Chief Executive Susan Morris's first open market purchase of company stock. Relative to about 485 million shares outstanding, however, the transactions were small. 7.2. Jeff Bezos plans to sell about $4 billion of Amazon stock. Jeff Bezos filed a plan to sell 15 million Amazon shares worth about $4.07 billion. The trades will follow a preset plan established in November 2025, with price, volume, and timing conditions determined in advance, reducing concern that undisclosed information is being used. The absolute amount is enormous, but 15 million shares represent only about 0.14% of Amazon's roughly 10.8 billion shares outstanding. Relative to the company and Bezos' original ownership, the sale remains small. 7.3. Increases and decreases in holdings, Schedule 13D filings. The latest Schedule 13D filings recorded completed trades by major shareholders. Tether Holdings increased its stake in Gold Royalty to 14.4% of shares outstanding. Pictet Asset Management, BW Group, Oman International Development and Investment and BBRC International reduced their positions in Fortune Brands Innovations, Navigator Holdings, International General Insurance Holdings, and Victoria's Secret. An entity that owns more than 5% of a class of securities must file Schedule 13D within 10 days and amend it when ownership or investment intent changes. These filings, therefore, describe recent changes in holdings and intentions, not analyst forecasts.
All right, we are now ready to enter today's main program. Before we do, please like, save, and share this episode so that other people who need it can also see today's content and become better versions of themselves. Thank you. You can now use the timeline in the video description or the pinned comment to find the articles that interest you and listen to them in depth.